we're encountering this year something over the past year that we have not seen as investors, as Americans, and as citizens for many decades, and that is rising interest rates, steeply rising interest rates, and high inflation. The two are obviously interlinked. Tomorrow, the Fed will announce what it is going to do with respect to interest rates. I'd like to get your insights on what you expect them to do, what you expect them to say, and they're trying clearly to engineer that elusive so-called soft landing, i.e. taper down inflation, but not crash the economy. How have previous soft landings worked out?
Well, we had a bunch in the 90s, and they were terrific. They're actually okay for the stock market, which I know is the concern of most. I will tell you that there are two that are the outliers that I fear. I fear the incredible 17 increases that we had at the beginning of the last, say, 2004 to 2006 was just a nightmare. And again, when Paul Volcker decided to break inflation in that 78, 79, 80 period, I want to take those out. Let's take those off the table. We've had many times, Tyler, where what's happened is the Fed has had to raise rates, and it got to the point where you saw that inflation slowed. They doubled rates in 1994 and 1995, and that was a terrific soft landing. With the stock market then proceeded to go up for 4 years. Do I think it can be that good? I have to tell you, I think that's much more of a possibility than the Bernanke period that was so destructive before the Great Recession. So I'm inclined to believe that there's something in between. And the in between is we get a slowdown that's enough to do the job, break inflation, but not break the economy, which makes me pretty bullish for 2023.
That is the sort of the best case and optimistic scenario that I could imagine, and I'm glad to hear you say it. You know, we've come through a month in October that was one of the best since the 1970s for the Dow. A lot of it was backloaded the last 3 weeks of the month. I wonder how you feel about whether the stock market has actually hit bottom or not. I know you can't, time the market. That's a fool's game. But I wonder what your instinct tells you about whether the biggest part of the decline is behind us, and maybe we're going to turn towards sort of brighter skies.
Well, I know just because I've been in the business for so long, a bit of a market story. In the 1984 period, we saw a remarkable thing happen. We saw tech, which had been a leader for a couple of years where you couldn't go wrong, crash. And the money went elsewhere. This period is like that. I think hitting bottom is difficult when you have a few stocks that have such large market cap and many stocks that have smaller market cap, even though they're in the hundreds of billions. I think what we're seeing right now is the denouement of big cap tech and the beginning of new leadership, which is from healthcare, from banking, even perhaps from retail, but certainly not tech. And I think that's something very new. It's something we're all going to have to get our arms around. But you have to recognize that there are other ends of the market, other pieces of the market, including oil, by the way, that can be remarkable. But we will lose the leadership of tech. And in some ways, I don't mind that one bit. The concentration of such increases in a handful of stocks has been a nightmare for many Americans, because they're afraid. They don't believe these stocks deserve that kind of market gain. People just don't think that Tesla should be $1 trillion, or they don't think that Microsoft should be $1 trillion. But if you have all stocks moving up, that is perfect for index fund buyers and for individual stock pickers. You've got the opportunity of buying stocks that are incredibly cheap. What an opportunity. And so I am thinking that tech is a donor and the rest of the market is a receiver.
That's very interesting, because I think over the past decade, certainly, and longer, technology has kind of defined many investors' sort of approach to equity investing, certainly.
Right.
And what I'm hearing you say is that we have to get ready for the disorientation intellectually, mentally, that will come from the idea that it's not just going to be tech anymore. We have a question from a participant named Bob, and this sort of goes to what you were just talking about. He asked, what sectors will best weather the economic climate in 2023? You seem to have partly answered that. It may well not be technology.
No, it won't be, I don't think. I think it'll be a little more eclectic. But first, I do think the banks will do well. They have been doing well. I mean, one of the things that no one talks about is the renaissance of J.P. Morgan. The stock has been unbelievable since since October. Same thing with Wells Fargo. How about Johnson & Johnson, Eli Lilly? These are PepsiCo. These are traditional American companies that have done quite well during periods where the economy slows. And what hasn't done well when the economy slows tends to be semiconductors, tends to be big cap tech when we've had these situations, except for FANG. I created FANG, and it's obviously now been bastardized because Facebook is now Meta, and we know that Alphabet was begotten by Google. But those are the stocks that are bad. And except with the exception of Apple, Netflix has come back, but it was only after it cratered. I want to add Microsoft as another stock that to me seems overvalued. Now, we own a lot of these for my investing club, but we have been cutting and cutting and cutting to the point where we've got it so that there really is only one large one, which is Apple. And I do believe that Apple is to be distinguished because it's a tech company, it's a consumer product. But my goal had been all year to slim down, ever since November of last year, to slim down on tech. And I've got to tell you, Tyler, I am still not done. The tech tyranny is upon us, and I am trying to minimize our investing club's exposure to the tyranny.
So you mentioned index funds a moment ago as you were discussing other things, and I'd just like to pause and get your thinking about index funds. I know you as a guy who loves stocks. I mean, this is your life. You look at companies, you look at corporate behavior and earnings and understand companies like no one else I know. But I wonder what your thought is with respect to the role that index funds should play in most individual investors' portfolios, whether those portfolios are taxable portfolios or whether they are tax-free or tax-deferred portfolios like in a 401k or a rollover IRA. What do you think of it?
Certainly,
indexes?
well, absolutely. Now, I have a proclivity to pick stocks, and I also have the desire, but also there's a degree of rigor that you have that to some people is boring. So I like to pick stocks. I do that for the club. But I've got two kids, and they're no longer kids, actually. They're 31 and 28. But when they were born, I set up uniform gift to minors, and I put their money in index funds. And, Tyler, I don't mind saying it. If you look at the index funds from when they were born, and you look where they are now, and you look at the maximum you could put in uniform gift to minors, they are both millionaires. Now, they are millionaires by default, meaning that I just put the maximum in, I put it in index funds, I wrote them up, never touched it other than every single year in January, put the Uniform Gift to Minors Act. And you could say, well, Jim, you just bragged about your kids. No, I'm just telling you, I put them in jar, I put all you were allowed in, and I put it in every January. And the result at their age is that they made a huge amount of money. Now, you could say, some people could probably say, Jim, that's hardly a lot of money. I think the vast majority of Americans who are watching would say that was pretty good. But all I did, Ty, was what the government allowed me to do and put it in index funds. And I think it's remarkable. But the main thing was I never flagged. The good years, the bad years, I put it in. And my kids are very thankful. They're spendthrift, but they recognize that I did it by doing index funds only. And I am very proud that I took advantage of that loophole. And I think everybody who's watching must recognize that that loophole is the greatest thing other than the IRA and the 401k, and it must be used because of what I just said. Good times, bad times. Invest. I like January.
How much?
That's the way I'm disciplined.
This is really, really helpful. Just for people who don't know, the Uniform Gift to Minors Act allows you to create this account that you are you're the custodian of. How much money can you put in every year, maximum, per child?
Well, you know what? That I'm going to defer to Sharon because once they reached 21, I was no longer allowed to do it. And I'm not sure exactly what the money is, but I'm sure, and that's my bad. I just wanted to bring this up. I didn't know that we're headed this way, but I just know that, and I defer to Sharon. But that was the big gift that the government gave me.
We'll get it. But I think that the main message there is a tool there that you should take maximum advantage of as to the best of your ability to do so. If it's the total maximum per year, do that. If it's something that's less for you, do that, and just be smart about it. All right, let's go to another question.
Right, because the point, of course, I'm trying to make there, the gift is there, but it said I just use index funds. I mean, I'm a stock guy, and I just said, all right, index funds, they'll be good. And they were. And I just urge everyone that I'm a stock guy, and I'm saying index funds are fabulous.
There you go. That is quote of the day right there. Let's squeeze in one more question from a participant named Joseph, who asked this. Do you see, and I'm not quite sure what he's driving at here, do you see the current market swing behavior continuing as the trend in the future? I guess that's big ups and downs. The past few years, the market seemed to have run on emotion first more than on economic forecasts and fundamentals. What do you say?
Well, unfortunately, we are in an emotional time in the country. Mm-hmm. And I think that that's somewhat coloring even the market. There are days like today where we're talking about a windfall tax profit on the oils. And you have to navigate that, but emotionally people would sell the oils and they'll buy them back. What I'm trying to do is get people to own, not trade, to invest, not rent, and to let these emotions create opportunities where you can buy stocks or put money in index funds because the emotions have created these ridiculous swings. The overall progress of the country is going to be positive over the next decade. And I think people should recognize that even if you bought stocks on the day before the crash in '87, 1 year later you were whole. If you bought stocks in 2006 and you went through the downturn, by 2013, you were whole. Now, that's 7 years, but then if you gave it the next ride, you made a lot of money. So what I'm saying is I just urge people to own, to not trade. And even though I had trading as part of my lifetime, I really think that owning is the best way. We like to own for the club. Sometimes it'll hurt us because we'll have really big gains and we didn't want to take them. But the vast majority of the time, it has helped us. And I think if people belong to or join the club, they will see what I mean about owning and not trading.